Anand Tandon joins us now with his market perspective. Anand, good morning and thank you for joining us. Anand, the month of December has been a good one for Indian markets, but December is history. What is more important is that what is in store for the month of Jan, which normally has a nasty history, and in the month of Jan we also would be pitted against numbers.
Well, that's right, Nikunj. I don't think the market is already trading at a near all-time high, and the valuations are now for the current year as well as for some part of next year more or less fully priced. So you have to assume that there is some reason for the valuations to change. That can happen because of either a sharp cut in interest rates, or it can happen because of some re-rating globally. I think the probability of both of them is a little low. I don't think that an interest rate cut is anywhere in the offing, and neither do I see any major change in the global macro. So for the moment, I would think that the market has a cap which is very close from where we are, which means that for the next few months you may again have a somewhat sideways or even downward movement.
The standout feature in the month of December has been the market breadth. Up until now, for 2013, we've stayed at a very polarized market, 15-20 stocks, at max 25 stocks which have done well. But suddenly last 4 months, more and more mid and small cap stocks have really started participating. Do you think the polarized nature of the market has already changed and will change further?
I would wait to see a little more proof for that. I think what has driven the change actually has been the fact that there has been a sudden spurt of new issuances in terms of mutual funds, many of them closed-ended, which have raised money for investing in mid-cap over a 3 to 5 year scenario. I would imagine that a large part of that upside has actually been driven by the investments that these funds have done. And once that money has been exhausted is when you really want to see whether or not the mid-cap rally continues to hold. That said, obviously the valuation gap between the large cap and the mid-cap had become fairly high. And since the liquidity was reasonably easy, there was some fundamental justification for buying the mid-cap. But to require a broad market or a broad economic growth for the mid-caps to kind of sustain, and I think the evidence of that is still lacking in the underlying.
Anand, what's the sense though that you're getting about the pharma pack? This has been a strong contender all of this series. Any favorites from there?
Well, pharma, has been an outperforming sector for now almost 4 or 5 years, and therefore most of the stocks there are reasonably fully priced. I heard Nikunj mention a little while back that the Biocon seems to have got its act together, so you'll have to look for stocks like that to outperform the market. That said, with the rupee still, I think, under pressure, anything which exports is going to do relatively better than something which does not. And therefore you still have the tailwind behind the sector. So I think broadly the sector would be marginally overweight, but I would be a little cautious at the top because most of the good news is in the price, and if there is any disappointment, you could see a sell-off there.
But Anand, is the valuation comfort still evident for IT? TCS, which has been a performing stock, is still trading at about 20-21 times, which is reasonable for a company which is growing at 20% plus. Infosys, which is up 50% this year, is still trading at 14-15 times. And the minute I look at mid-cap IT stocks, even after the recent run-up, most of the quality mid-cap IT stocks like Persistent, Mindtree, Tech Mahindra, they're still trading in the early teens.
Absolutely. I think, the IT sector is far more comforting for two reasons. One, as you mentioned, the valuations have been, on a historic basis, are lower than where they have been. Partly that was explained by the fact that the growth rates were lower. I think what we now see is that the growth rates are picking up, and they are likely to do better this year if the US GDP growth comes anywhere close to what is being forecast currently. So there is a likelihood that there will be an uptick in growth, and that will sustain a higher level of valuations as well. I think between the two, I would imagine that IT has probably greater scope and greater margin of safety right now.
Anand, talking about IT, what about names like Infosys? Does it seem like top-level exits and 8 of them would impact Infi's upward trajectory?
Well, Infosys has a very strong, management cadre, and they've been around for a long time. So, many of them would be kind of itching to take the top spot. However, that doesn't mean that there will not be a hiccup, because obviously whenever there is a change of guard, there will be a bit of uncertainty at the next level as well, as people kind of scramble to get their positions more secure. So to some extent, the company is likely to become somewhat more inward focused. But I don't necessarily think that a change of guard is all bad news, because sometimes you need fresh blood. Whether it should happen all at the same time is a different question. And I think that is something that is a cause of some concern. But overall, I think the depth of management is strong enough for them to be able to move along with the market, especially when the market is beginning to look up as well.
Anand, that is the line the management has been taking. That look, we've got a strong management team in place. We've got enough tier 1 people, enough tier 2 people, enough tier 3 people. But as of now, markets are giving some benefit of doubt to Infosys stock, and they believe that it could be the turnaround story of 2014. Do you believe in that argument? Do you believe in that logic?
Well, if you were to look at a comparison between Infosys and, let's say, others which do not have this kind of flux, the question is that, would you really put your money into Infosys, or would you, let's say, buy a Wipro, which also seems to be getting its act together? And I would argue that, where there is less news is better news. So in an environment where, the tailwinds again seem to be behind you, it is perhaps better to go for a company which has less, question marks around what it is doing, than to go along with something which is, trying to make a lot of waves. But however, as I said, it's not as if, Infosys is in any kind of serious trouble or anything. They have been reporting decent numbers. So this quarter may be something that one has to watch out for, because there is some indication that the numbers may be slight kind of flattish. But, overall, I think because of the fact that the industry has kind of again gone back on a growth track, I would be too worried about it, given its current valuation.
So what is your big Nifty 50 idea for 2014, where you are, let's say, ready to allocate about 8 to 10% of your total portfolio?
Well, because unfortunately the markets move very quickly these days. So, there is very little chance of you really taking a really long-term call and sitting on it for a year. You have to keep on watching every quarter at least what goes on. But I think broadly, anything to do with exports. So, as I mentioned, IT is definitely a favorite, and to me, among the biggies, for example, I like Wipro. I must give a disclaimer that I also own that stock. There are other stocks also among the larger ones like Telecom, which have already done quite well, but have no reason to not continue to perform. And I think the two-wheeler space continues to be fairly interesting.
What about the auto-related themes, Anand? We've seen the tire space really emerge as a winner all of this month. Any names that you like there?
Not really. I think tires is far too cyclical a business. I don't think that it has ever been a great, barring perhaps one company, it has not really been a great value creator per se, because of the fact that the commodity prices are too large part of its overall cost structure. And so long as rubber prices remain low, the margins remain reasonably decent. But that's a structure. The industry itself is structured in a way where you have to have more and more radials. The technology for that doesn't exist in India. We're still having to import it. So the raw material cost is a very large percentage of overall sales. So it's not to me a very exciting sector. It is something that you have to play whenever the cycle works for you. And I think it just has, and therefore perhaps from now on it will be a little more difficult to get that kind of.
Final take on the way engineering stocks have done. Voltas, Crompton, BHEL, Thermax, ABB, Siemens, all of them are up more than 15 to 20% from the recent lows. Now, the economic cycle for some of these companies has not bottomed out. What explains the fervor in the stock price?
I think it's just the lack of quality names that one is looking for that is driving some of these. Because as you mentioned, I don't think there is anything that is visible in terms of either order book or even potential order book in the near term. So you're really taking a bet that somewhere in the next 6 months the economic cycle will begin to turn and the order book will come through. Remember, the valuations that many of these companies are today trading at is such that even if that were to happen, I don't think it will make too much money there. So some of these stocks are probably just dead cat bounce kind of thing, and it's better that one is very, very cautious unless someone has a 3 to 5 year view, because you're not likely to make money on this.
Anand, appreciate your time and thank you for joining us.